On this 3rd of April, we're kicking off the first trading day of the second quarter. Mike Ingram from BGC Partners joins us now with an outlook for Q2. Mike, it's been an interesting Q1, I think marked most notably by the fact we have very low, and in fact almost record low volatility. Do you see a continuation of that, or are we set for change?
Well, it's difficult to see volatility remaining where it is, because if you look at it, FX vol low, equity vol, embedded in the VIX low, bond volatility very low as well. So, to some extent, that's priced for perfection, and it's easy to see where the tripwires might be in Q2 and for the remainder of the year. So, politics is certainly going to be an issue. Both sides of the Atlantic, of course, we've got the ongoing Brexit negotiations. We've coming out of this 9-month or so period of purdah. Now the rhetorical floodgates are opened. Against that, we've also got ongoing elections in France for the presidency. We've got elections in Germany later on. And to some extent, the UK, it's easy to use as a sort of a political piñata, if you like. And then, of course, over the water, Trump in deep trouble in Capitol Hill. It doesn't seem to be able to get any legislation through. Within the last 24 hours, tweeting, I think, that he's prepared to use trade as leverage against China to get them to do something about North Korea, and saying, well, if you don't do something, we will. I'd be surprised if the market continued to be quite as relaxed as it has been over the last three months.
What about central bank activity? We saw the Fed deliver in Q1 with an interest rate rise. Do you see the Fed going again in Q2?
It's possible, but I think it's increasingly contingent on what is delivered on Capitol Hill, and of course, it's anybody's guess, quite frankly. Interesting to note that we had a succession of Fed speakers during the course of last week, and they all pretty much reiterated their view that another 2 hikes or even 3 hikes was probably appropriate, consistent with the most recent dot plot, and that's despite the fact that they knew that, for instance, the Affordable Health Care Act hadn't been repealed and so on and so forth. So they seem to be taking the view at the moment that a fiscal stimulus is probably in the pipeline, even if somewhat later than expected, and against that, tightening monetary policy is probably going to remain appropriate.
From the Fed, but how about the ECB? Could we see the ECB begin to indicate that it's time to think about tapering?
Well, they've taken a baby step in that, haven't they? So, for instance, the most recent rate-setting meeting and press conference, they said that they didn't think there was downside risk to their forecasts. And in fact, based on the incoming data, I think it's quite likely that they will be looking in June to further upgrade their economic outlook for the Eurozone over the next 3 years. However, they didn't feel sufficiently confident that they were prepared to go that next step and remove that asymmetry to the rate outlook. They were still saying current rates or lower. So it was but you saw the market react even on that, and the market is now, the ECB has fought very hard to try and dial down on talk of tapering, talk of rate rises. We've got Mario Draghi talking in Frankfurt on Thursday. I'm sure he wants to dial that down, and of course he's a very tough crowd there. But you've still only seen the market's expectation of some sort of rate hike dialed back from 80% prior to the last MPC meeting down to about 60%. So the market is still convinced that probably on a 12, 15-month view, we will see rates, obviously from a deposit rate of minus 0.4%, start to edge up towards zero. But of course, before then, we're likely to see indications of tapering. What I've got in mind as a sequencing is economic upgrade in June, probably starting to talk about tapering in September, and actually starting to execute that when the current asset purchase program formally ends at the end of this year.
I want to take a look at economic data as well, some of your choice economic data this quarter, but I want to do this in the context, first of all, of inflation and the Bank of England, to continue the central bank theme.
Right.
Inflation here is creeping up. We know why. There's a lot of factors coming in, not least of which is lower sterling, which possibly could well continue at these levels. That being the case, it's going to be a bit of a headache for the Bank of England, isn't it?
Yeah, and we've got some PPI numbers out in a short while, which will continue to support the the picture, that there's a lot of inflation still in that pipeline, still hasn't necessarily been passed through to consumers. For me, there's a bit of an inconsistency to the Treasury and the Bank of England's view on the economy, because they have got a relatively low inflation forecast. They're looking at maybe topping out at 2.8% on the CPI, but also 2% growth forecast. And I think you could only get to 2% if the consumer is still batting at the crease, is still doing very well, still very confident. In that environment, I think that the manufacturers are going to be more confident in passing cost increases through. So you're right to see, more of that pipeline inflation actually realised in the headline rate. And even though the Bank of England is at pains to try and dial back on expectations of a rate hike, I think the market is actually right to think that certainly the next move is up, and a rate hike even as soon as this year is rather more likely than perhaps certainly than the Bank of England is expecting. Because at the moment they're signalling no move on rates for the entirety of the Brexit negotiations, the next 2 years. I can't see that happening, particularly in an environment as well where the ECB might be looking to raise rates, the Fed is certainly looking to raise rates, certainly within that 2-year time frame. That leaves sterling pretty vulnerable, and we're going to be reminded, I think, on Friday when we see our trade numbers. We need those inflows, and we need to make sterling attractive.
Talk about Friday. Non-farm payrolls, of course, on Friday,
yes.
Kicking off this quarter. What do you expect there? I mean, you were absolutely spot on with the number with us in our live report last month. Are we going to see a continuation of 200,000 jobs a month? Is that realistic?
That's not the market expectation this time around. Certainly, I mean, we'll get some sort of insight when we see the ADP numbers on Wednesday. But I mean, on the ADP numbers on Wednesday, we're expecting a significant slowdown from, I think, 298 to 196, I think is the number. For the non-farms on Friday, we booked, 235. I think we're looking for a number closer to 180. And that's a lower number in its own right, but it's also below the 6-month trading average at 194. So a bit of a slowdown. Wouldn't surprise me if we didn't also see a surprise to the upside. But I think actually, beyond the headline employment count, I think, as has been the case for quite a while now, it's the average hourly earnings numbers which are probably more important from the Fed, in terms of their inflation mandate. As far as they're concerned, the US is more or less already at full employment, and there you're actually looking for a higher monthly number, 0.3 on the month, but because of base effects, a lower year-on-year number from 2.8 to 2.7%. So. Again, if we could see a significant deviation from that, there may be a Fed rethink in the pipeline.
Broadly speaking, global equities, where do you see the money shifting?
Certainly, to some extent, there has been a bit of a bond market reprieve. And again, that's courtesy of the Trump reflation trade moving around. So, yes, there are. I think equities are still ahead, but it's not a home run as it was looking at the start of this year. Within that, you've definitely seen a change of leadership. You've definitely seen, the US as the epicenter of the Trump reflation trade. That's faltered. You've continued to see better numbers, particularly out of the Eurozone, and you've seen that in the relative performance of Europe versus the US, for instance. You've seen it in the decline of the dollar, and also because you haven't seen this disorderly rise of the dollar, which looked a possibility. If you look at what we did in the fourth quarter of last year in terms of the dollar index, we're thinking, well, if there's more to come, this could be problem. It would be problematic for emerging markets. Again, emerging markets have also been let off the hook. So we shifted from US onto Europe and to some extent emerging markets.
Okay, all right, Mike, it's a pleasure. Thanks indeed for setting us up there for the second quarter. That's Mike Ingram from BGC Partners.